Good afternoon, everybody, and welcome to EBW's first webinar of the year. My name is Howard Pressman. I am one of the planners and a partner here at Eganberger & Weiner. Happy belated New Year to all of you. We are excited to kick off the year with this presentation. We're coming off a pretty crazy year, both in our country, the world, and the markets. And there's a lot of uncertainty going forward, whether it's policy uncertainty or uncertainty with the virus and the vaccinations and so forth. So this is a great way for us to begin planning and discussing what's next. So we're very happy that we have Mark Peterson with us today, who is a director in the BlackRock Advisor Insights team, focused on investment strategy and education. He's a 25-year industry veteran with extensive experience and expertise in educating financial professionals and investors on market and investment topics. Mark's responsibilities include relating BlackRock's investment strategy and investment views to financial professionals and clients. Mark is also the author of the popular Student of the Market monthly publication that is distributed widely to financial professionals like myself across the country. And prior to joining BlackRock, Mark was a director and head of product strategy and economics at Deutsche Bank. Mark has also spent time on the floor of the Board of Trade and the Chicago Mercantile Exchange. He also received his BS degree from Arizona State University. So after all of that, I'd like to turn things over to Mark.
Great. Thanks, Howard. Good afternoon, everybody. Thanks for joining the call today to talk about the market and the economy and where we're headed in 2021. As Howard mentioned, not a shortage of content, right, given everything we've been through here the last 12 months. But we'll try to keep it brief and hit the highlights of what we think is important. There's a handful of things that we think are really driving the story here into 2021. Obviously, we'll try to weave in some of the comments about the virus and the economy. Those things certainly are tough to gauge and really predict in any accurate way. So certainly notate that in advance. But we'll lean on our Student of the Market piece, which Howard mentioned is something we do on a monthly basis. And that's something that really leans on history a lot. We always think it's a good way to good baseline of knowledge around markets and economies to understand what's happened in the past. Obviously, everything doesn't repeat, but as Mark Twain, history doesn't repeat, but it often rhymes. So that's what we try to do in Student of the Market, is really lean on that historical context to better understand where we might be headed. And also overlay some of the thoughts BlackRock has just about the health of the economy and the direction of the markets, et cetera. So we'll certainly hang on and have some questions towards the end if folks have any. But let's jump right in, and hopefully everybody can see the Student of the Market screen. Yell at me if it freezes up here. But I think first off, let's just start with where we've been. I think, it's hard to think back to 2019. Probably seems like two lifetimes ago, right, before 2020. But 2019 was a great year for both stocks and bonds. Stocks were up 31.5%. Bonds were up 8.7%. That's well above average for both stocks and bonds historically. Stocks generally average around 10% a year, going back about 90 plus years of good data. And bonds average about 5. So about 10 and 5 is what you can expect. You got 31 and 8. Not too shabby in 2019. And we followed that up last year, even though it was a wild ride and a lot of drama to get there. We did finish the year up 18% in stocks and up 7.5% in bonds. So you can see another year in which we were well above average for both. Which is really rare historically. We actually went back in the time machine and looked at how many times this has happened where you've had back-to-back years in which both stocks and bonds were well above average, right? Well above that 10 and 5 average on an annual basis. And you can see it's only happened 4 other times since 1926, which is about 95 years of history. It happened most recently in 97, 98, and then twice in the mid 80s, once in the mid 70s. But prior to the 70s, you didn't have any period back-to-back calendar years in which both stocks and bonds were well above average returns. So really fortunate, right? I think when we look back, 2019, 2020 were good returns for both stocks and bonds, right? That core building blocks of any portfolio. So that's the good news. The bad news here is that there is no third year, historically anyways, where you have above average returns again for both stocks and bonds. So something's got to give. When we look at it, bonds are probably the most likely weak link here. Bonds, we've already seen interest rates back up a little bit for us here to start out 2021. So bonds are showing flat to negative performance so far this year, and stocks are off to a good start. We were slightly down in January, but we've rebounded here in February, and we're positive in a fairly healthy way to start out the year. So that's certainly what we'd expect heading into the year. But I thought it was good to have that historical context about where we've been from a return standpoint, set expectations that, hey, it's been a nice run probably for most portfolios here, but it's not going to be quite this easy in 2021. It doesn't mean that both asset classes will struggle. We'll talk a little bit more about why we think the backdrop for stocks is a little bit more positive and why bonds might be a little bit more challenged here in 2021. Now, one of the defining stories of last year was the volatility that we had in March. We had, and this is not on the slide, but I do think it's interesting that we had 3 of the worst days in stock market history in March. So we just looked at all the days since 1950. Last year had 3 of the worst 15 days. I think number 2 and 3 actually in market history. So certainly that's a pretty rough ride. But one thing I think we always lose sight of is we also had 5 of the best 15 days in stock market history last year. So think about that. 3 of the worst and 5 of the best. And that's often what we see when the stock market is pretty volatile, is you get some of these best and worst days sitting right on top of each other. They all live in the same neighborhood. So you just need to fight that temptation of derailing your investment plan that Howard and team have in place for you, because you don't want to miss some of those best days on the other side. So, I think that's something that we saw to a T last year. It worked out perfectly that you had some of these worst days and they were followed by some of the best days. So I thought I'd just highlight that reality that we saw last year, just such a defining element of a really volatile stock market. When we get into a period of time where really what the market's doing, it's trying to digest what the economic impact is going to be, right? It's that economic uncertainty that's so elevated. And last year, of course, it was because of the virus and the economic shutdowns that were going into place that created a lot of uncertainty in that March, April time period. So the other defining feature that I thought was fascinating last year was that the largest stocks within the U.S. stock market dominated performance, right? They were the biggest and best performers. And you can see we just ranked the stocks in the U.S. stock market, the S&P 500 index, by the largest names. So number 1 through 5, and these are all the names we know, right? Apple, Google, Facebook, Amazon, right? All those, Microsoft, all those top 5 largest names, probably some of the companies were very well, we know a lot about and probably deal a lot with, right, on a daily basis, especially in quarantine. They were on average last year, 52%. Just tremendous performance. Remember, the market as a whole did about 18. So this is well above the overall market for just these top 5 largest individual stocks. And that can be a challenge because it makes investing seem easy, right? Just own the biggest stocks in the index, own the biggest companies in the economy, and you'll outperform the market. And of course, we know that doesn't last over time. This performance won't last. These top 5 stocks won't go to the moon from a pricing standpoint. You can see what some of the other groups did here. 6 through 20, not too shabby either, by the way, 28.6. But you get down to the 400 smallest stocks within that S&P 500, number 101 through 500, and you can see they only returned 9.3% for the year. So the market last year was really top heavy. which is not, certainly not something you'd look for. It's not the healthiest thing. You don't want all the performance from the stock market or the economy coming from a handful of companies, right? It's much healthier to see a broad-based strength across the market and the economy. And this group, this last group, that 100 through 500, 101 through 500, that was actually negative through the end of September. So we actually did see a pretty big rally in that group in the fourth quarter of last year and into the first 2 months of this year. So that's a healthy sign that some of those smaller companies have started to participate in the rally, catching up to some of those biggest names that we know the best. But I wanted to throw that out there because I do think it is a little bit of a trap. Where folks just think investing becomes easy, right? Just own the biggest well-known names in the stock market, and that's what does well, beats the market as a whole. This just doesn't last. And I thought I'd throw that out there as a reminder. We see that historically, that just this burst of performance that we saw in 2020 amongst the largest names just doesn't tend to be very sticky. And you see it start to revert back. Where some of these smaller company stocks do catch up and do a lot better. And certainly part of that is the outlook on the economy, right? With the vaccine rollout, cases are falling across the country in a big way. We're back to under 65,000 hospitalized across the country for COVID, which is half the peak. And it's back to early November levels. So certainly, beyond just the vaccine rollout, which has gotten a lot of the headlines, we've seen that curve really come down in a major way. It does not mean that we still can't have another spike, especially with various other strains roaming around. I think one thing that we've learned is that anybody that's tried to predict the virus and how this resolves itself has been tremendously humbled. So certainly that's been difficult, but I think the signs are pointing for a more stabilized and durable recovery across the economy across the country. So I think that's a bullish sign. That's why we're seeing some of these smaller companies that maybe were more penalized by shutdowns start to rally in a bigger way. The market really starting to see the light at the end of the tunnel of the virus and the shutdown, and really impacting those companies that might be more impacted by a durable restart of the economy. And you see that in the small cap performance chart. And on the left side, that's looks like a really busy EKG, right? But it's the 4-month rolling performance of the small company stocks versus large company stocks. And just over a 4-month period of time. And normally I don't like to show such short periods because it can be really fleeting. But it does show an enormous burst of performance for small caps over large company stocks. So just showing that last year's anomaly where those largest stocks are the dominant performers isn't going to last. And you can see that at the end of January, small caps were outperforming large caps over the last 4 months by over 26%, which is enormous, right? Just a small period of time, you're outperforming by 26%. That's the second largest gap in history where small caps have outperformed large caps. The other was another burst of performance back in February of 2000. But I thought that was interesting. And just to note that burst of performance, when we looked at it on whether it's pretty sticky and whether it lasts or is it just a short burst, it looks like it actually tends to last a little bit. If you look on the right, we just pulled out the top 10 periods where small caps outperformed. And you can see 3 years later, small caps actually outperformed a majority of the time. Not in every case, right, which is what the market tends to do, right, that everything doesn't work out perfectly. But you can see where history trends here, that when you do get a burst of performance, the performance tends to be sticky more often than not, meaning that the leadership that small caps continue to do well versus large caps over the next 3 years. So I think that's something that we look for certainly this year into 2021. We think, again, because of this dynamic and the economic fundamentals behind it, we think that's certainly a positive backdrop for smaller company stocks. Now, one of the issues we talk a lot about within BlackRock is the fact that there's a lot of money on the sidelines, both in money market accounts and in bond mutual funds and exchange traded funds. And we often look at these flows to get a feeling on what the overall sentiment is in the market. So what we mean by sentiment is, are people investing in stocks? Are they investing in lower risk investments like bonds or cash on the sidelines accounts? And probably not a huge surprise, but last year was a record for cash on the sidelines, both money market accounts and flows into bond mutual funds and exchange traded funds. And it was record outflows into stock mutual funds and exchange traded funds. So just an enormous divergence between stock and bond flows. And this just, and it probably shouldn't be a shock, right? Given everything we went through between the virus and the health concerns, the shutdown and the economic concerns, the market volatility, that a lot of folks really didn't take a lot of risk during the course of last year, went to more conservative investments. Maybe some of it was rebalancing back to bonds following such good years in stocks, especially in 2019. But it was a record divergence between stock and bond flows last year. You can see it at the end of this September. It was about $745 billion between the two. You can see that the other peaks were only half of that historically, going back to October 2012. And the interesting thing about this is that if you can go against the crowd or going against the herd, it's actually a great way to invest. We just looked at any time bond fund flows significantly outpace stock fund flows. The stock market averaged 15% the next 3 years. And granted, there's not a huge sample size here, but there's a handful of different periods here where whenever folks were rushing into more conservative investments, it was oftentimes a great time to buy stocks. And you see that the case with that 15% return. Bond returns in that period were only 3.4%. So even though the dollars were flowing into bond funds, they returned less than average, while stocks did well above average. And the opposite is true as well, which I think is fascinating. Whenever stock fund flows significantly outpaced bond fund flows, that was not a good sign for the stock market. You can see the stocks only did about 1.2% on average the next 3 years, right? Tremendously below average. And bond funds on the flip side actually were better than average at 5.8% per year over the next 3 years. So I think this is just a fascinating story of investing and investor psychology, right? That oftentimes investors start to think alike. And it's very easy to think that the actions of others are the right actions. But when it comes to investing, oftentimes going against the crowd is a great way to make money longer term. And I think you hear that from all the famous investors historically. You say if you have the fortitude and the will and you can go against the crowd, sometimes can be a challenging proposition. But it's a great way to invest over time. And that's really what this chart's showing you. Is that whichever way the sentiment's going, it's often best to go the other way. Of course, today, the story hasn't changed much. We saw record inflows into bond funds in January. Stock fund flows were pretty flat, but bond fund flows still getting a majority of dollars. You know, maybe, again, some of that's rebalancing after a great year last year in stocks up over 18%. So maybe some of that's a rebalance, but I think you still see a lot of cash on the sidelines, and some of that's from the stimulus the government's put in place, right? Some of that's from the savings. Folks haven't gone out and spent money like they would in a non-quarantined economy, right? So you just have a lot of cash sloshing around on the sidelines, and historically, that's a really bullish sign for stocks in the near term. Eventually, those dollars find their way back into the stock market at some point, and that tends to be very supportive of prices in the near term. So probably one of the biggest things we're talking about when we talk about things with folks with inside BlackRock is all this cash on the sidelines is going to be really supportive of stocks in the near term. Now, stocks certainly aren't cheap, especially here in the U.S., right? They might be cheaper in other places like emerging markets or international, which have lagged U.S. stocks 8 out of the last 9 years. So certainly maybe not a bad time to rebalance the various different parts of your stock portfolio, but we do think the backdrop for stocks is pretty positive here. Switching gears now a little bit and just talking about on the bond side, this is a chart that looks at interest rates going back to the 1920s and then bond returns by decade. And it really shows the nice relationship where bond returns generally are pretty easy to predict. Generally nothing's easy with the markets, right? But generally, bond returns tend to be easy to predict over long periods of time. Short term is another ball game, but over short periods of time, interest rates and bond returns kind of go hand in hand. So if you look at wherever interest rates started the decade, that's generally where bond returns finished. Like look at the 90s and 2000s, right? You started, interest rates were around 6-7%. That's where bond returns finished the next 10 years. And of course, the challenge today is that interest rates are at historical lows. We're actually at about 1.2% on a U.S. 10-year Treasury bond, which is what we're looking at here. So we've come up quite a bit from the end of last year, but still historically low relative to this 95 plus years of history. We thought interest rates were low before the pandemic. They've gone a notch lower here during the pandemic. So it's clearly a challenge because 10 years from now, we're going to look back and bond returns are going to be right around that 1% level, right? They're going to be right around that 1% level. The lowest bond returns that we've seen since the 1940s and the 1950s. You can see the 2 decades for the 40s and 50s, bonds returned less than 2% for 20 years, right, of the 40s and 50s, coming out of the Great Depression and World War II. Interest rates were really low, and that translated into low bond returns for an extended period of time. Unfortunately, that's where we're headed. And that's certainly a challenge given the fact that we've got all these baby boomers retiring, looking for income, looking for conservative investments, and we're at a point in history where they're the toughest to find at this point in time. It's just the ultimate financial irony that we're stepping into at this point, that with all these retirees, that interest rates and income is so difficult to find. So that's certainly a challenge for portfolios, right? You think about, especially the last 2 years being such good return for bonds, 8 and 7%. That's just not going to last. That's going to come back to the level of interest rates that we're seeing today, right around that 1% level. So unfortunately, that's a little bit of a sobering news for portfolios, but it is our reality moving forward. And certainly there's some things we can do around this. We can add some flexibility to your bond portfolio, add some various different parts of the bond market that can add a little bit more income, a little bit more flexibility. Active managers certainly do really well in a low interest rate world on the bond side as interest rates trend higher. So certainly there's things you can do, and you can talk to Howard and team on what you can do to evolve your bond portfolio. But we think adding a little bit of flexibility there makes some sense. You probably just need to balance that additional risk out with maybe a little less risk on the stock side. But certainly this is going to be probably one of the other big stories within BlackRock that we talk a lot about is how do we invest in a low interest rate world, right? It's just a different dynamic than we've seen the previous really 70 years prior to this, where interest rates were anywhere between 3 and 12%. Right, just a different world from an investing standpoint, and has big implications for portfolios going forward. Now let's finish up one last idea here, and this is certainly, and you can see I have a lot of favorite charts, but this is probably one of my favorites that looks at investing in a diversified portfolio. This is a year-by-year look, or I guess it's more than a year-by-year. It's a handful of years, different bear and bull market periods, and we're just looking at a diversified portfolio versus the S&P 500 or the U.S. stock market. And the diversified portfolio is about 60% U.S. stock, or excuse me, 60% stocks, 40% bonds, spread through various categories within stocks and bonds. And I know everybody will have a little different portfolio based on your risk tolerance, based on where you're at in your investing life cycle. But we thought it was just a good proxy to show the emotional dynamic of owning a diversified portfolio. Normally, when we do these sessions in person, I always joke with folks that you have a really well diversified portfolio if it never feels good, right? You have a pretty good mix of asset classes if it never feels good. And that's what we're seeing on this slide. And I tried to capture the emotions with my fancy emojis there on the slide. If you can see the emojis, that in a diversified portfolio, you still lose money in a difficult market. Like 2008, no better example, right, than 2008. You lost 24% in that diversified portfolio. That never feels good, right? You can't hide that anywhere. Certainly 24%. It was probably one of the worst years ever, by the way, calendar years ever for a diversified 60-40 portfolio. And then you follow it up with that 11-year stretch when the bull market returns. And this was the longest U.S. economic expansion in history. U.S. stocks were up over 350%, but the diversified portfolio is only up 195, right? You trailed by over 150%, just diversifying your assets between stocks and bonds, right? And we had a lot of folks who wondered if that was the right mix, if they should have owned more stocks, right? Should have had a little bit more risk in the portfolio, they would have captured more of that upside. That's a natural feeling where you just don't make as much. And we see that quite a bit, especially because those periods can last an extended period of time. And we saw the exact same thing last year, except in kind of a shorter time period where you still lost 20% in that diversified portfolio in the first quarter. And then you only made 42% the last 3 quarters of the year while the market was up over 70%. So you just get this emotional dynamic where it never feels like you're getting ahead with that diversified portfolio, right? You lose money, you trail, you lose money, trail. You repeat this over extended periods of time. It's really tough to connect the dots on why this diversified portfolio makes sense, just because it never feels good. And what you miss, of course, is the punchline here that I'll bring in, is that over this 20-plus year stretch, the diversified portfolio actually wins. So the diversified portfolio actually ends up ahead of the U.S. stock market, not to mention it does so with a heck of a lot less risk and a lot less drawdown of your initial dollars invested during some of those difficult markets. So I thought just a good reminder for why we build portfolios the way we do, why we asset allocate and diversify and spread your investment eggs across a variety of investment baskets. It's really get to a pattern like this. And what we at BlackRock, we call this winning more by losing less. Winning more by losing less. We don't need all the upside of what the bull market brings, right? We left 150% from 2009 to 2019. But if we do a better job in a downturn, that's what has a bigger impact on our overall outcome over a full market cycle, which is a bear and bull market in combination. So just a good reminder why we build portfolios the way we do. Even some of the best investors we work with need this reminder from time to time. I think it's good to take a step back and just connect the dots, right, from various markets, because we tend to get caught up emotionally in whatever period we're going through, right? Whether it's a good market or a bad market, that tends to drive our emotions at the time. Good to take a step back and see the bigger, longer-term picture on what really drives success. And that's why risk is such a critical piece for us here at BlackRock, right? You just do a better job when the tough market comes. That just has such a bigger impact to your overall outcome longer term. So I thought that was a great way to finish and just tie up a lot of the things we touched on. You know, again, a little bit of a mixed bag from an outlook standpoint for 2021, certainly coming off 2 great years for stocks and bonds in 2019 and 2020, well above average. Bad news is there's no third year, right, where you continue to outperform. We think bonds are going to struggle a little bit more so than stocks. Again, stocks seem to be benefiting from all that cash on the sidelines, right, that we touched on. All the cash that is flown into bond funds and into money market accounts, those dollars eventually will find their way back into the stock market and be very supportive of prices here in the near term. Certainly areas like small caps and emerging markets, we think have some potential for some nice returns this year. And then on the bond side, adding that flexibility to deal with low interest rates, certainly something, again, Howard and team can help you with. And most of all, remember, right, the story of the diversification piece, why we build portfolios the way we do. If we can get to that winning more by losing less story, right, that's really what we're trying to achieve. It's not just less risk. It can really do well in a really volatile period of time. And I didn't mention it. Think about the last 20 years that we see on this chart, by the way. Right, we had a tech bubble bursting. We had 9/11. We had a global financial crisis. We had the longest U.S. economic expansion in history. We had a global pandemic as the cherry on top. So it's been a pretty remarkable 20-year period in history. And the diversified portfolio has held up as well as it's had. I think that's really all you need to know, going forward. So let me stop there, Howard, see if there's any questions, comments, thoughts that you have that you want me to fill in the gaps on, or anything that you want to add on.
All right, Mark. Hey, thank you very much. We're going to go ahead and open it up for questions now. So at the bottom of your screen, you'll see a question and answer box where you could click on that and enter any questions that you might have. But Mark, I love the comments that you made about a diversified portfolio. That is definitely what we preach here. And, I always like to say that, if we're doing it right, it's boring. You're not going to be talking about this at a cocktail party or wowing your friends with great stories as everybody else is telling you about the killing they made in GameStop or Bitcoin or whatever. You're not going to be grabbing anybody's attention with your boring diversified portfolio.
Yeah, no, absolutely. And I think, both of those examples, the Bitcoins and the GameStops, is a little bit of the concerning mentality I have with the best stocks dominating performance last year, right? I think it really feeds into that mentality that investing's easy and can lead to some of these bubbles and some of those some of those securities that you mentioned. I just think it's right. It's just the environment's ripe for it. And I think it never ends well, as we've seen historically.
Right. Yeah, exactly. I mean, do you think has GameStop and what happened there with the, with the internet, cowboys coming in and really taking over and kind of, at least on the surface appeared to do battle with the largest hedge funds in our country. Has that changed anything, do you think, in the markets?
I don't think fundamentally, right? I think you've seen a handful of these things happen historically. I think the press always wants to make it about right the big hedge funds versus the small investors. I'm sure and you'll never know this, but I'm sure there was a lot of large players as well with those small players to make the stock move the way they did. So my suspicions are that it was. It wasn't quite as clean as the small guy against the big guy in that trade. So, but I think fundamentally, we've seen these things, and they pop up from time to time where they call it a short squeeze, where you just get something that gets out of whack over a short period of time. It tends to be something that fades to the background pretty quickly, and I think we've seen that with the GameStop experience.
Yeah, no, I completely agree. And as I was reading about it and and doing some looking into it, it definitely appeared as if it wasn't the story that we were told in the media, that there were definitely some big players on the side of those little guys. So we got some great questions here. Number one, how has COVID affected the market? What about pharmaceuticals?
Yeah, no, certainly COVID's had a big impact on the markets. I think that also contributed to some of the performance we saw last year, where some companies benefited from the shutdowns, right? Think of Amazon, right, was a prime example where they benefited from folks being confined to their home and ordering goods online, and certainly they're the big player there. Certainly pharmaceuticals, healthcare has benefited, right? Certainly really brought a lot of those companies into the spotlight, showing how and really flexible, and how quickly they reacted getting the vaccine out certainly helped that part of the market, pharmaceuticals and healthcare broadly. I think that's one area of the market that we like as well. And I always kind of like healthcare, to be honest with you. I think healthcare, especially with an aging demographic country and developed world for that matter, a lot of those healthcare companies are well positioned. They tend to be not quite as expensive as a lot of those tech stocks. They tend to be equally held in both growth and value portfolios, if you know what that is. So equal representation of healthcare. So it's got a nice balanced approach. And even when the market pulls back, healthcare tends to do pretty well. So that's an area I always tend to like. Granted, we have probably the best healthcare manager, so that probably skews me a little bit because she's such a resource for us. But that's another area we like for 2021.
Great, thank you. So policy changes and tax code. Obviously, the Biden administration has communicated a number of policy proposals. Much of them revolve around tax changes. Specifically in corporate taxes. Do you have opinions or thoughts on that?
Yeah, no, it's a great question. Certainly one we've gotten a lot, even going back to last year. It really appears that the administration's going to front load a lot of stimulus. We didn't talk too much about stimulus, but clearly that's going to be another positive, especially for stocks here in the near term. Right, any additional, whatever size it comes into, right? It's crazy that we're talking in trillions of dollars now, but it'll be a positive to the market. And they haven't really talked much about raising taxes, right? It's kind of in the background. And this is kind of what they signaled to the markets last year, was that they were going to come in and put in a lot of stimulus coming out of the shutdowns, out of the challenges we had with the economy in 2020. And really front load it with a lot of stimulus. I think they recognize that, right, if the economy is still trying to recover, trying to stabilize and durably restart across the country, that it probably wasn't the best time to put tax increases. Not that they might try to do something, right? Maybe you put something in place, you change the estate tax, which certainly would have big implications in some areas. Or you try to do some other things, but you save some of the bigger tax increases on the corporate side, on the individual taxpayer side, till maybe years 2, 3, or 4. And honestly, that's what we saw in the Obama administration. If you think back to Obama's first 4 years, he ran on a very similar platform of repealing the Bush tax cuts, but they didn't do that till year 3 and even into year 4 of their first term. So they waited, coming out of that global financial crisis, really 3+ years to put those tax increases into place. So I think they know that it might be a little bit treacherous if you put a lot of tax increases on the board as the economy tries to recover. Then you run into the 2022 midterm elections, right? That could be a formula that puts you in a bad position from a party standpoint. So, the indication is that a lot of stimulus and not so many tax increases here, in 2021, 2022.
Okay, great. Thank you. So our next question is about Bitcoin. I know we could probably have an entire, hour presentation just on this topic alone. But can you spend a couple minutes and, why is Bitcoin valuable? Why is it even a thing?
Yeah, that's a great question. We get it occasionally. And I wish I had a great answer for you, because I certainly don't. I have a tough time valuing it as well. I think clearly there's some desire for an alternative currency to the U.S. dollar, right? There's just, what else can translate value across an economy? So I think that's part of the fundamental story here. And obviously part of it also plays on technology as well. But I always struggle with these type of investments, even some certain commodities. When you don't pay a dividend and you can't grow earnings like a stock can, it's really tough to value
such an asset class, right? I even struggle, like I mentioned, like things like gold, even though we know they have inherent value, right? They don't pay a dividend or they don't pay an interest rate, and they can't grow their earnings. So I think it's just really, really tough to value them. And over long periods of time, they tend to be just the price of inflation over time. But that's certainly not the way Bitcoin looks, right? In the near term, tremendously volatile. I don't think we have any agreement within BlackRock on what it means or how it evolves here going forward. So that's kind of a long-winded answer to say that we don't have a good answer. But certainly something we'll keep an eye on. But I think that's the foundation of why it's getting some interest. Again, for me, it's just tough to value because it doesn't have that growth or earning potential that a traditional stock and bond has, which makes those much easier to value in the short term.
Okay, so it's probably a little bit more than just hiring a hitman on the dark web.
Yeah, exactly.
All right. So do you still see a 40% stock and 60% bond portfolio for older Americans, or maybe you would flip that?
Yeah, no, I think really depending on your risk profile and where you're at your investing life cycle, this is where the team can really help you out on what best fits for you. I think, one of the things that is part of the low interest rate reality is that you can have a 40-60 or a 60-40, and they can look very different, right? Based on what the 40 and 60 look like, especially in that low interest rate world. So I think that's something to think about is that, maybe you get a little bit more aggressive with stocks, right? But maybe you still own 40, or maybe you own a little bit more than 40, right? And maybe you get a little more flexible on the bond side, but own less, right? On the bond side. So I think there's different combinations that can work based on again, your risk profile, risk tolerance, and where you're at in your investing life cycle. Also depends on your income needs, right? And what your income profile looks like as you move into retirement. So to say that there's a one size fits all, I think that's just not the case. I think, as we all know, that's where the investing and the financial planning tends to be a little bit of art, a little bit of science, right? To make what best fits for each investor, right? It would be easy if it was just a one size fits all, right? We'd solve a lot of drama, but I think we all know it's a little bit more advanced than that.
Yeah, I definitely agree. And given the challenges that you were talking about earlier in this interest rate environment, with what's happening in the bond market, I will tell you that nothing around here garners more conversation than the bond market does right now, and what's happening, and how we invest in this environment for our clients. So that's a big topic of conversation that we are having here, and something that our clients will likely be hearing more from us on in the coming weeks as we really continue to see how we position portfolios in this environment. It is, it's definitely a challenge. And I think, I've been doing this now for 21 years, and this bond environment, I think, is about as challenging as I've ever experienced myself.
Yep.
All right. So we've got a question here about political risk. I'm not sure, maybe you have an answer, but the question is specifically about domestic political risk, and it says, it seems higher now than in my adult lifetime, according to the person asking the question. So any thoughts on that?
Yeah, certainly. I think natural feeling coming off a really divided partisan election, right, last year. But, one thing that's interesting, we spent a lot of time last year talking about it, is that the politics just don't seem to have an enormous impact on the market longer term. It's actually pretty amazing when you look at the history. And I'll give you one example of this most recently that I think is pretty shocking. If you looked at the best performing sectors of the stock market under Obama, they were tech, healthcare, and what they call consumer discretionary, which is like Home Depot, Nike, those kind of stocks. And the worst performer was energy. So So think about those three: tech, healthcare, consumer discretionary. Worst performer was energy, right? So that was under the Obama administration. Under the Trump administration, the best performers were tech, healthcare, consumer discretionary, and the worst performer was energy. Exactly the same, right? And the two administrations couldn't be more different, right? Both stylistically and from a policy standpoint. Yet the performance by sector within the stock market was, at least from an order standpoint, was almost exactly the same. And I think that's a good example of what we see longer term, is that the market and the economy tends to have its own direction. And certainly politics and policy impacts it on the edges, but bigger picture, longer term, things like, right, different parts of the energy segment tend to take a long time to play out through the economy. Things like even the global financial crisis, right? That was probably building for 40 plus years, right? You have some of these things that happen in the economy and the stock market and even in the bond market, that are such more longer term than administrations and policies can impact in the short term. So, I think you always hear, both parties think they're better for the market and the economy. The reality is, I think the market and the economy tends to have its own direction longer term. So I don't know if that's reassuring. I kind of think it's reassuring that the most non-partisan part of our society today might be the market and the economy, right? That it tends to have its own path on where it's headed.
Yeah, those are all great points. And recently, in a piece that I wrote for our clients, I took a look at research that showed that when presidential approval ratings are low, market returns tend to be higher. And I know that really goes against common sense, but the research definitely bore that out.
Yeah, no, we actually looked at something similar. The favorability ratings, or is the country headed in the right direction? And it was actually better to buy stocks when everybody thought the country was headed in the wrong direction, like they were right at points of last year. So it is, again, similar to what we looked at earlier, kind of that contrarian indicator that if you can go against the herd, if we know all the bad news is built in, which is basically what those studies are telling you, right? It's probably not a bad time to buy stocks.
Yeah, it's very counterintuitive when you look at it. And what I've also found very interesting was a different study that showed how people felt about the economy based on political affiliation. And there are definite times when Obama was in office, Democrats felt much better about the economy, and Republicans felt that things were all headed in the wrong direction and things were terrible. And then when Trump came in to the presidency, suddenly Republicans felt very jubilant about the economy and quite excited, and Democrats were the exact opposite. And I think if you look at it from a more objective standpoint, under both of those administrations, you could certainly make the argument that our economy was quite strong.
Yeah, no question.
All right, so I'm going to do with one more question here, and then as we're getting to the end of our time together here. So let's see. Here's a good one. What are your predictions on the solvency of the Social Security system?
Yeah, certainly. You didn't end with a small one there either, by the way. As you mentioned, Social Security.
I said it was a good one.
Yeah, I think there's. Yeah, some of these others were a little bit easier than this one, but certainly Social Security is something I think we all know is a challenge, right? Similar to a lot of some of the debt and deficit challenges that we have as a country. I think Social Security is. There's some flexible fixes that certainly would help Social Security quite a bit, right? Different ways to change it and make it extended out quite a bit. So Social Security, I think, is not one that, at least for us, is top of mind, a challenge. I think the backdrop of just really big government deficit and debts, tend to be a bigger challenge, right? You're kind of stealing growth from the future, right? Because at some point you're going to have to deal with the debt and deficit challenges, right? It's easy when interest rates are low, right? That's the good news of low interest rates, is that it's cheap to finance a lot of government debt. The problem is, as we all know, and as the chart showed, interest rates won't stay low forever. So I think that's a bigger challenge than Social Security. I think Social Security you can start to bend things like the age you qualify and things like that, and that starts to change the trajectory of the viability of Social Security by a lot. So I think that's why you don't hear about it quite as much as you used to. I think folks have looked at it pretty hard and understand that maybe it's more about a tweak than a major overhaul that's needed to make it sustainable.
Yeah, and the Biden administration put out some policy proposals last year that sought to address the funding problems at Social Security, and specifically the biggest part of that proposal was to start charging Social Security taxes on income over $400,000. Under the current system, Social Security taxes are no longer levied on income over a certain amount, and I will get the number wrong, but it's around 135 or somewhere around there. So you pay full Social Security taxes up to $135,000, and then no Social Security taxes on income above that amount. And what the Biden administration proposed was to continue to cut it off at 135, but then reinstate it at 400. So there's kind of that donut hole in there. And certainly, while the projections did not completely fix the Social Security challenges, it did go a long way towards fixing it. So it does look like this is something that's being considered. All right, so I think that's all the time that we have together today. I know that there are a few questions that we did not get to, and I'll be happy to answer those questions in the chat box if you would like. I want to make sure everybody gets answers, and certainly if there is a question that you had and we weren't able to get to it, I invite you to reach out to your financial planner here at EBW. And we will be very happy to answer that for you. I would also point you to our website and our blog, www.ebwllc.com. There are some resources there. Recently, myself and Brian Beatty wrote a synopsis of what happened last year, and Brian wrote about our thoughts going forward. Two really strong pieces that do answer some of these questions and kind of talk a little bit about what Mark was talking about. So I would encourage you to go find those pieces and lots more wonderful insights on the blog on our website. But Mark, thank you very much for joining us. I thought the presentation was outstanding, and I really enjoyed it. I think it's very helpful. And to all of our clients, thank you all very, very much. As always, I appreciate that you spent your lunch hour with us, and I hope that we get to have some conversations, and I really look forward to the time when we get together in person again. With that, I will bid you a wonderful day, and stay well, stay healthy, and thank you all for your trust and your confidence. Bye-bye.
Thanks, everybody. Thanks, Howard, Brian.
Bye-bye.